Hello and welcome to Moneylife News and Views. I'm Debashis Basu. The cloud hanging over the Indian stock market has lifted for now, or at least that's what the assumption is. India's trade deals with the United States and Europe and the European Union have reduced one of the biggest risks embedded in Indian equities for the past 1 year. Amid tariff and geopolitical uncertainty, foreign investors pulled out heavily in 2025, more than 1.7 trillion rupees, making it a year when Indian equities lagged most of the emerging markets. And this is a surprise, but yeah, it's a fact. The trade deals are already nudging capital flows back, even if cautiously. A lot of smart investors are now convinced that we will witness the start of a bull run, especially in small cap stocks, which languished in 2025. Yet, markets do not move only on removing uncertainty, they move on growth and earnings. And here the story is more complicated. Indian equity markets currently face two major challenges: weak demand and high valuation. Although I must say, in this recent quarter, that is in the December quarter, earnings have been fairly good. A bull run is usually driven by a cyclical economic upswing combined with a low starting valuation. India is not a compelling case on either of these two counts. India's domestic story remains fragile, even as tweaks to the goods and services tax have created episodic consumption bumps. The drivers of underlying purchasing power are missing. Wage growth, particularly in rural area, has been weak or stagnant for the past few years when adjusted for inflation. This has constrained mass consumption. Weak wage growth matters more than headline GDP growth for equity markets because it drives volume expansion. Without real income growth, demand relies on credit expansion or government transfers, both volatile drivers. Now, that partly explains why corporate earnings growth has lagged headline GDP growth last year. The consequences are visible in private corporate capex, which has remained cautious since the twin balance sheet crisis of 2010s. Even though balance sheets are healthier now, capacity utilization has only gradually improved, and companies remain wary of building excess capacity in an uncertain demand environment. India's uninspiring equity underperformance of 2025 reflected moderate earnings growth and weak demand. Now, will this change with trade normalization? Well, it should help export oriented sectors where India is already competitive at the margin: textiles, generic pharmaceuticals, parts of specialty chemicals, engineering exports, and other products. But none of these are new growth engines, nor are they large companies which are going to pull up the overall market. Rather, they are beneficiaries of global trade reopening. India's share of global merchandise exports has hovered around low single digits for years, even during the hyperglobalization era. Despite 2 decades of global integration, India has struggled to scale up manufacturing exports the way China or Vietnam did due to logistics cost, regulatory friction, labor productivity gaps, and supply chain depth. Trade deals reduce barriers, but they do not create competitiveness. Now, that's very obvious. But the excitement of two mega trade deals has pushed the macro picture: low domestic demand and low export competitiveness, away from the headlines for now. They're going to return very soon. This leaves one dominant growth engine, that is government capital expenditure, which has become the central pillar of India's growth model. The union budget of 26-27 has pushed public capex to above 12 lakh crore, the fourth year of the largest infrastructure push in India's history. But there are two caveats. One, infrastructure spending brings direct benefit only to businesses participating in government funded projects. These are only a few smaller listed stocks, apart from one giant, which is Larsen and Toubro. Second, allocation is not execution. Audit data has repeatedly highlighted structural inefficiencies. One CAG review, a review by Comptroller and Auditor General, found cost overruns of 1.07 lakh crore across 442 projects, with delays stretching up to 16 years. In infrastructure audits, project delays have ranged from 3 to 39 years, with costs overrun in extreme cases exceeding 3,000%. These numbers matter because infrastructure spending works only if productivity gains materialize. Otherwise, capex becomes fiscal stimulus without long term growth multipliers. And that brings us to a key question, which is valuation. If there is less to cheer by way of organic demand led growth, that does not dampen the optimism among smart Indian investors, especially in small caps. But here comes the second challenge to that optimism, which is valuation. After a brutal correction in 2025, valuations have reset in some parts of the small cap segment. The small and mid cap indices fell sharply during risk-off phases last year, mirroring broader foreign outflows and domestic liquidity tightening. This has created the perception that a cyclical bull run could emerge if liquidity returns and domestic investors re-risk. But it's also conditional on earnings revival to match the current valuation. India's equity market has traded at a premium to other emerging markets for more than 2 decades, reflecting superior corporate governance perception, stronger return on equity, and structural growth expectations. But that premium has widened in recent years. Forward price to earnings multiple for MSCI has been roughly double those of emerging markets in some periods. Even after recent correction, India continues to trade at a very high premium to emerging market peers and in some cases remains the most expensive major market globally on forward earnings multiples. That valuation gap partly explains why MSCI Emerging Markets Index significantly outperformed Indian equities last year, with some estimates showing EM returns exceeding India by more than 20 percentage points. Meanwhile, Indian equities delivered near flat relative performance, reflecting high starting valuations and modest earnings growth. The structural premium for India is logical. India offers political stability, deep domestic capital markets, and favorable demographics. But high valuation demands continuous earnings growth. When earnings slow, even briefly, relative underperformance follows. This is where blanket optimism by small caps would get tempered by reality. Liquidity driven rallies can occur, but sustained bull markets in India need earnings compounding because valuation re-rating has happened already in advance. The overall takeaway is this: trade deals reduce downside risks, they do not automatically create growth. India's structural constraints, which are export competitiveness, uneven wage growth, cautious private investment, remain largely unchanged. All indices have been flat to down since the first hours of excited rally on Tuesday following the trade deal, and then after that, the scare about AI taking away software business has really made the markets go back down, and it's almost near what it was before the trade deal was announced. We may get tactical rallies after this, especially in beaten down small caps which are doing well, showing high earnings growth. But until real incomes accelerate, demand revives strongly, private capex broadens, and earnings growth revives overall, valuation is likely to act as headwinds. If you like this video, please do share, and thanks for watching.